I will get us kicked off. I want to thank, of course, our panelists, a group of experts for joining us today, for sharing historical context for what is a very, very important subject for the American FinTech Council. For those who don't know, and interesting for this panel specifically, before we were the American FinTech Council, we were actually the Marketplace Lenders Association. And so we have been steeped in the issues of true lender and usury rates, and I don't know what you're going to call it, but DIDMCA or DIDA or DIDMCA or however Amber is gonna take this conversation. We've been in this space for many, many years, and I just want to thank the experts at Arnold and Porter for moderating, for being a part of this panel, but for their partnership all year long. I'm always fascinated that firms are willing to work with us and pay us, and then be able to give us all the free advice that we need. And so we just thank Arnold and Porter, because we lean on them day in and day out for their legal expertise on so many issues that come up. My name is Phil Goldfeder, folks. I probably should have started with that. I'm the CEO of the American FinTech Council, and we are excited to bring to you a lesson in history, understanding the lasting impact of DIDMCA and the True Lender Doctrine. This is a continuation of our Future Finance webinar series. As I mentioned earlier, and I think worth saying again, you have some of the leading experts in the country today, but folks who have been in this fight and part of this conversation for so many years, and probably some of my most favorite people. And so with that, Amber, I know this is not going to be an easy one for you, but I know that you're capable of it, and really just thank you and thank everybody who came to listen. I look forward to a really, really great conversation.
Thank you. Thank you very much, Phil. Thank you to the AFC team for having us. As Phil mentioned, I'm Amber Hay. I'm a partner at Arnold & Porter in the Financial Services Group, and I have the pleasure to serve as the moderator of these esteemed panelists. We are going to get into the discussion shortly, but first I want to give the panelists the opportunity to each introduce themselves. And let's start with, you all know, you people that are within the AFC community, these people are well known, but for any newcomers, please, panelists, will you introduce yourself, starting with Marty?
Sure. I'm Marty O'Malley. I'm an assistant general counsel at Prosper Marketplace. I'm responsible at Prosper for all borrower-facing matters, including regulatory matters, litigation matters, and for our government affairs. I'm also deeply honored to be the chair of the board of directors of the American FinTech Council.
Thank you, Marty. Next, can we have Tom?
Hi, all. Tom McCormick here. I'm with BMG Money. I'm not well known, Amber. It's nice of you to say so, but I'm relatively new on this scene, at least this scene. I'm a former attorney. Early in my career, I did bank regulatory work, but I've been on the business side for some time now. BMG is a employment-based lender, so we make consumer loans secured through payroll, and what we're trying to do is help give people technology-enabled alternatives to what we view as predatory payday and other high-cost loans. So happy to be here. And if I say something and Marty says the opposite, go with Marty. That's my only advice. So
Tom and I have worked together a lot for quite some time now.
Thank you. Next, Rico.
Rico Izaguirre. I might be having Wi-Fi issues with the hotel. Speaking of acronyms, funny story, the MLA, as Phil was referencing earlier, the Marketplace Lenders Association, the acronyms for that were the MLA. So since it's going to be a big acronym heavy afternoon, thought I would do that little historical tidbit. But Rico Izaguirre with Affirm, thanks for having me.
Thank you, Rico. And my colleague, Chris.
Thank you, Amber. Yeah, Chris Allen. I'm a Arnold & Porter lifer. Been in the enforcement, compliance, general counseling for financial institutions for about 20 years now, and have really enjoyed working with the entire industry. It's really been great. So look forward to this discussion.
Awesome, awesome. Okay, well, we're going to jump right into the questions. We will reserve some time at the end for Q&A portion, but to the extent there's questions from the audience that it makes sense to answer sooner than later, I'll be looking out at the chat box, so please feel free to add your questions there. So let's get started. First question, you already alluded to the acronym DIDMCA in the intro. That stands for Depository Institutions Deregulation and Monetary Control Act of 1980. This law is recognized as one of the most important laws impacting financial services, and the Federal Reserve identifies it as one of the most important laws to affect its agency ever. So Chris, could you give us a little background of what is DIDMCA and why is it important?
Sure. We'll keep trying to keep its memory alive. So DIDMCA is important for a number of reasons, some of them related to what we're going to discuss more in depth later, and I'll try and focus on those. But just to, as you alluded to, Amber, it's important for a number of reasons. So there's two, as the name suggests, there's two really core components of it. There's the deregulatory part, and then there's the Monetary Control Act part of it. And the Federal Reserve in particular really was strengthened by DIDMCA. You have to remember, and this is kind of core to the whole discussion here and to the parts that are important to our later discussion, the context in which DIDMCA was passed. It's introduced in the middle of 1979, signed in March of 1980. The U.S. is going through extreme inflation at the time. I mean, just to put kind of a fine point on that, Jimmy Carter signed this law on March 31st, 1980. At that time, I looked it up, the federal funds effective rate was 19.85%, and the discount rate was 13%. So you can see that inflation, interest rates were skyrocketing, and the Fed was having a hard time getting it under control. So one of the purposes of the act was to empower the Fed with certain new tools. It applied, so the DIDMCA required that all depository institutions be subject to the Fed's reserve requirements. It expanded the Fed's reporting requirement abilities, so they all had to report to the Fed. It expanded their ability to lend, the types of collateral they could accept, the types of fees they could charge. So it really strengthened the monetary policy strengths of the Fed. That was one piece of it. Another piece was the deregulation part, and that's more what we're looking at today. In the middle, there's the fact that it increased the deposit insurance cap from 40,000 to 100,000, where it would stay for 30 years, basically, till the financial crisis. But then we had a number of pieces of it for deregulation. One of them, and this starts getting into our discussion today, one of them was that it repealed, or it started the repeal of Regulation Q, which was the limit that went back to the Glass-Steagall Act that the Fed imposed on how much you could pay on deposit accounts, savings accounts, and demand time deposits. And in 1980, that was about 5.25. And so if you think about the stress that that's putting on one aspect of a bank's business, the market rates were over 10%. Banks can offer 5% on their savings accounts, on their deposit accounts. That's not very attractive to would-be savers, and so they're looking elsewhere. They're putting money in money market accounts, and other sorts of disintermediation are going on, taking banks out of the equation and putting a stress on banks' funding sources. At the same time, think about the basic business of banking. The old, you might remember the joke, the 3-6-3 rule. You borrow at 3%, you pay 3% on your deposits. You lend at 6%, and you're on the golf course at 3%. A bit of a tongue-in-cheek thing, but there was some truth to it for many, many years, for decades, even the 50s into the 60s. Interest rates were such that was possible. You start going through the 60s into the 70s, and interest rates are slowly creeping up, and then late 70s, not slowly anymore. And so banks not only are facing stress on their funding side, but you look at the bank model works as long as you can charge more in interest than you're paying in interest, right? Well, so now start thinking about state usury caps. Take a state like Arkansas. There was a 10% constitutional usury cap. Not easy to legislate around. And so if you're an Arkansas bank, you're faced with the problem of, okay, I'm looking at 10, 15% to get money. I can only lend it at 10% though. So, that doesn't work. And there are other states where that's a similar problem for the state banks. Compounding that, the national bank down the street, under the National Bank Act, Section 85, they have an alternate usury cap, right? So they can charge the interest rate of the state that they're located in, and we'll get to that concept of located in. But they also can charge 1% above the discount rate at the reserve bank in their district. So they've got a market-based rate. So they can still lend profitably, whereas the state banks that are stuck with a state usury limit are not able to do so. So some states address this. They introduce parity laws, say, okay, a state bank can charge the same thing as a national bank, but other states don't get around to that. And this is really becoming an existential threat to these banks, right? And so either they're faced with, well, we need to change our charter, or we need to get some relief on interest rates. So Congress and DIDMCA, and they do this in a couple of spaces. There's mortgage lending. They totally remove the usury caps on home residential mortgage loans. But they also, in Section 521, which is what we're talking about, they level the playing field and they say, okay, state chartered banks, and it's banks, it's commercial banks, savings associations, credit unions, you all get the same powers as national banks. So we're going to put everyone on the same footing, recognizing that there is, there's a federalism aspect here and a states' rights aspect. They say, okay, with all of these, if you state you don't want your banks to have that extra credit limit, that extra usury option, okay, you can opt out. You can back out of that. But we're going to initially give it to everybody because we think that everyone, banks should all be able to compete. So, it's important to we now get lost sometimes. We look at, the other important aspect of that parity was to get you can charge the law of the state, and you couple that with interest rate exportation from, a Supreme Court case a couple of years before that, Marquette Bank, where the Supreme Court said, yes, you can, if you make a loan in the state, then that state's law apply. But that was really in the credit card context. It was, interstate lending was not a big thing at that time. What Congress was trying to do was not introduce interest rate exportation. They were trying to give this escape valve, if you will, for state chartered banks that needed to be able to charge above their state usury limits to keep the economy going, to be able to lend, to not fail, to keep the housing market moving. This was to provide credit to small businesses, to commercial enterprises. This was a threat to the economy. And what they were doing was giving this other, what was front and center was this other interest rate limit, not exportation. So, making sure we keep it in the context of what was going on and what they were trying to accomplish helps us understand, as we're going to get to, why the court ruled like it did in the Colorado litigation, and what it really means to opt out under 525 of DIDMCA. And so we're going to move into that. But I think it's important to understand what was going on at the time and what Congress was trying to accomplish with DIDMCA and with these provisions in particular. So it wasn't a consumer protection statute. It was a lifeline to banks.
Chris, you're giving us the whole spiel in one response. We're going to dig into this a little bit deeper and slow it down a bit for people that weren't able to catch that. But Chris that was a phenomenal background. And for this session, we're really going to focus on the changes made to allow for parity of national banks and state charter banks. But let's flip to that one point you mentioned at the very end in terms of the opt-out right of states, to the extent that they do not want their state charter banks to be able to have this interest rate exportation option. So Tom, let's start with Rico, actually, because you were on the front lines, to my understanding, lobbying against some of the state DIDMCA opt-out legislation in your prior experience. Could you provide a little bit background there on your experience in the terms of how states were thinking about these issues?
Yeah, happy to. And yeah, Chris, I think that was a very good and deep historical explanation. But I think the bottom line, and I'm not an attorney, I have a master's in public policy, but not an attorney. Bottom line there is DIDMCA wasn't a consumer protection issue. It's really a bank parity issue. And so it's become this, here's this very blunt tool to address a problem, which, from our association's point of view, we by and large agree lending above 36 is predatory, and compound interest and all these other things that are, bad things. That's why none of our members lend above 36. So the idea that the opt-out provides this magical relief for consumers actually is somewhat contrary to, to what would actually happen should, these states begin, these opt-out provisions, because at the end of the day, you still have sovereign nation lending, you still have payday, you still have rent to own, you still have check cashing, et cetera, et cetera. All you've done is taking away potential good actors that are offering products below 36% APR, below the Military Lending Act rate. From our perspective, there are more elegant ways that aren't as blunt a tool to potentially get the same effect without there being this much more draconian strategy of the opt-out. We've done this in Illinois. We did this in New Mexico. You can create these rate caps and give the regulatory bodies the protection and the tools they need to be able to go after bad actors that are exceeding those rate caps. A predominant economic interest test above 36, or an exemption for those below 36. That really provides the same effect of chilling the ability for some of the high rate lenders to be able to, offer these loans. So there are ways to do it that aren't so draconian. And I think that's really the political and policy piece that I would want, the takeaway to be.
Thank you, Rico. And before I want to turn to you next time in terms of your thoughts of why this opt-out provision was even included in DIDMCA. But for newcomers, I want to clarify what is meant by that opt-out right is basically states are authorized to enact a law that would opt out any loans made in their state from this regime of being able to, have interest rates exported from a different state with respect to that loan made in their state. So Tom, what are your thoughts on why this opt-out provision was even included in DIDMCA?
Yeah, well, one of the things you'll hear sometimes is people that believe that the opt-out should be interpreted to provide that a state can ban an out-of-state bank from, quote, coming into their state and not exporting from the state in which the bank is truly located. Sometimes they'll say, well, I know that must be the right conclusion, because if that's not the conclusion, then the opt-out is entirely meaningless. And I don't think that's fair. I think in context, we have to remember we're all nerds, right? And we know about dual banking. Most people don't reflect on whether their bank was created under federal law or state law, but that's the dual banking system. And so it's pretty obvious to me that a bank, that if the federal government is going to agree to charter national banks and the OCC is going to sort of administer that regime, it makes sense to me that the federal rules generally should apply to the conduct of that national bank. And if the state of fill in the blank wants to provide laws that say we'll allow a bank to be established under our laws, I think it's pretty reasonable to assume that, well, the general conduct of that bank maybe should be conducted in accordance with that state's laws. And of course, there's lots of areas where we have the national truth in lending, the national this, national that. But I think that's a fair thing. And look, so if someone had told me as a layperson, states are generally allowed to export, state banks are allowed to operate nationally according to the rules of the state in which they're headquartered. Oh, but there's this thing that says that states can opt out. I can imagine a reasonable interpretation is, that must mean that states can ban other states from coming in and operating. But even though that's a reasonable lay interpretation, I don't think it's the right interpretation. I think that the opt-out basically said, hey, as a federal legal matter, we are now going to start empowering state banks to do something that it wasn't clear that they could do last week. But hold on now. We don't want to just trump, bad word, we don't want to trump the state's abilities to govern the conduct of the banks that are created under their own laws. So we're going to let states opt out of it if they want. And I think that's the better interpretation. And the Colorado litigation is about that, and specifically where a bank is made. But again, Chris gave a great history lesson. I just want to remind everybody, in 1980, if you wanted a credit card, you would drive to your local bank branch and ask for a master charge application. I think it was still called master charge then, right? Or maybe you go to a hotel and write, like on the front desk of the hotel, there'd be some American Express paper applications, right? It was a different world. I think the world got better for consumers when we started having lots of banks involved in national lending programs, whether it's credit card or not. And if we had a world where the state banks were at a decided disadvantage against national banks, well, I think there'd be a lot fewer state banks and a lot more national banks. And I'm not sure that's what the states would have wanted. So I think there's a perfectly sound rationale for why the DIDMCA opt-out provision was created. It doesn't necessarily lead you to conclude that the opponents of our trade association's point in the Colorado litigation, that's what the litigation's about. Like, okay, reasonable people maybe disagree about what this thing means. We need to know. We need to know what it means. And that's what that litigation's about. So states and consumer protection folks and lenders and borrowers all know what the rules are. And if we want to change the rules, then somebody can go to Washington and introduce, we can reverse it or change it somehow. But let's at least have clarity on what the heck this thing means. Because again, if you only hear a sentence or two, you can conclude it means something that I don't think it does. Right? So that's where the litigation comes in.
Absolutely, Tom. And you
I believe, Tom, there was a movie called The Princess Bride where you are using that word and it doesn't mean what you think it means.
Thanks, Rico. And Tom, I agree with you. There's other areas of the law where we've seen, specifically like the FDIC, in terms of activities of state charter banks under federal law, they're generally allowed to do whatever a national bank can do, with the exception of any limitations under state law. So a reading of the opt-out in a similar manner makes sense. Chris, I want to get a little bit more in terms of, before we jump into the controversy, there's these terms that we mentioned. It's the opt-out rights with respect to loans made in a state. And what does it mean for a loan to be made in the state? And what is a home state? What does it mean for a bank to be located in a home state? If you can give us a little, background on that, Chris, that would be great before we jump into the broader discussion.
Sure. Well, so home states generally interpreted as your home office, your head office. But the OCC, in interpreting the National Bank Act, has repeatedly determined that a bank a national bank is located for these purposes in each state that it has a branch. And then you look also, when we're talking about lending activities, to where certain key elements of the lending activity take place, the decision to extend credit, the communication of that, the disbursement of funds, to determine where a loan is being made. And that's, this goes, again, I mentioned Marquette Bank from 78 about looking at where a loan is made versus where the borrower resides. And there was a Nebraska bank that was making a loan to Minnesota residents, and the court said that's fine given the facts of this, and we have interest rate exportation flowing from that. But so and then because these provisions that were added, like so DIDMCA added provisions, in this case to the Federal Deposit Insurance Act, it added Section 1831D for the interest rate piece to mirror what national banks had. Because that was specifically patterned off of the National Bank Act, it has been interpreted consistently with how the National Bank Act has been interpreted, so that you look to where the loan is being made under those criteria, and that's the location of the bank for these purposes.
Thank you. So the understanding is, for us, is generally it's a federal law. You look to how the federal regulators define how a loan is made. At least that's the position, my understanding of the plaintiffs in the Colorado case. Right,
and how the courts have interpreted it, and because now the FDIC has, they came in and took a position in this litigation that was not entirely consistent with where they'd been before in their rulings, but and guidance. But yeah, right, you look to federal law.
Okay, absolutely. And so then we have this thing out there called the True Lender Doctrine, and Valen Wade. I'm going to jump to you, Marty. Could you give us a little bit of background on what is the True Lender Doctrine actually, and how does it fit into this discussion?
Sure. So one of the things I think is helpful to sort of, in the way of thinking about it, is that the North Star, I think, for people who are trying to be in this area is essentially to drive interest rates down to the state rates, the lowest interest rate that they can find. And so some of what we're talking about here is DIDMCA, and some of what another sort of avenue to arrive at that is through the true lender theory. And I just want to take, before I get into true lender, I want to take a little bit of a side turn to distinguish it from the valid when made doctrine, because these two doctrines are often linked together, and sometimes they're used interchangeably and sometimes they're confused. And they are actually also trying to get at this interest rate, this state interest rate limitation thing through different avenues. So if you bear with me, I'm hopeful that I can sort of distinguish them and then tell you which one you need to pay attention to. So I'm going to start with the valid when made doctrine because it has come up and sort of is mostly settled. But the valid when made doctrine is really about when. And it's not about who makes the loan, but it is when the loan has been made, what happens then? So for the person who subsequently inherits the loan or acquires the loan or gets the loan after the loan has been made, do you still accede to all of the rights and responsibilities and obligations that were aligned to the original maker of the loan? And for the longest time, I mean, and by the longest time, I mean over 100 years, this was well settled. There's this concept of the valid when made doctrine. It's in the case law from the 1800s. So that's 18, not 19, not 20, 1811. So 1811, a long ways back. And basically, the idea is that once the loan is validly made under the laws that govern the creation of the loan, then a subsequent holder of the loan retains or inherits the right of the person who made it. And this was longstanding case law. There was nothing particularly exciting about this. This went on for a very long time until a case in 2015 called the Madden case. And it's a complicated case. It's well documented. I will give you the very, very brief highlights of the case, but essentially the case revolves around a credit card that was issued by a national bank. And the credit card subsequently, or the holder, you know, the borrower didn't pay on the loan. The loan is subsequently charged off and it's sold to a debt buyer. And the debt buyer is not a bank, it's a state chartered institution. And it happens in New York. And the interest rate in New York for a non-bank is 25%, and the interest rate on the loan is 27%. And so the borrower sues and says, hey, this is usurious, this is unlawful, you can't do this, it's well above the interest rate, and we can't have this. And the bottom line, leaving out so much of the law, is that the court came out and said, you know what, you're right about that. That's really the bottom line. And it went to a variety of other places. It went up and down, and the court never addressed the valid when made doctrine. And this caused sort of great disruption in the secondary markets, because it really attacks the ability of the secondary markets to buy loans, to trade loans, to invest in loans. And it really limits the ability of the originating bank to make loans. Because if you can't sell your loan with carrying the original interest rate, you either hold them on your balance sheet or you bring those interest rates down to the rate at which you think you can then resell it. And that either restricts your ability to make loans because your balance sheet is full, or it restricts your desire to make loans at higher rates, thereby shutting out lots of borrowers. Either way, so many, and I want to be clear, I'm wildly oversimplifying these concepts. Either way, what it does is it causes great disruption in both the lending market and in the secondary financing market. So there's a lot of pressure for a legislative fix to this whole problem, and that did not happen. So then in 2020, both the FDIC and the OCC issued rules codifying as a regulation that the interest charged on loans that was permissible before the loan was transferred remains in effect after the loan was transferred. And then there were some attorneys general who challenged this rule. And in February 2022, there was a district court decision that essentially, again, I'm oversimplifying, upheld this regulation. The attorneys general did not appeal within the time allowed for appeal. And so essentially, the valid when made doctrine is now codified in federal law. So the importance of that is that you basically, for most purposes, can no longer attack the interest rate on the loan after the loan was validly made. So those people who are looking to attack the interest rate, they then move to a second avenue. And that is closer to what we're talking about now, and that is called the true lender doctrine. And the way to think about that doctrine is not when, but who. So if the valid when made talked about like what happened after the loan was made, the true lender doctrine talks about, well, who's making the thing in the first place? And so the true lender doctrine really seeks to say, okay, you know what, bank, you may have your name on the loan, but you're not really making the loan. You are working with a partner, and that partner may have certain things called that partner may have marketed the loan, the partner may have the predominant economic interest in the loan, the partner may be engaged in certain activities such as loan servicing, or if you can't really, sort of pin down one of those, under the totality of the circumstances, we will say that it's actually the partner that is the lender and not the bank. And that's really the concept of the true lender doctrine, which is looking through to, often with a microscope, to the facts and circumstances of the transaction to find some way to say that it's not the bank that's the lender, it is the partner. And if it is then the partner is no longer entitled to the benefits of the state and federal banking laws. And this theory seems to have started in 2004 as a result of some actions to try and drive payday lending out of the state of Georgia. And it made subsequent appearances in different court cases around the country in 2007 in New York, in 2014 in West Virginia, in some other cases in Maryland and in California and in Colorado.
Marty, so it sounds like, is it still a doctrine? Have any of the agencies tried to make a regulation or any other attempts to codify it?
So, great question. Also in 2020, the OCC issued a rule which would, in theory, have settled this avenue. And the OCC's rule basically was that the bank that was named as the lender in the loan agreements, they're the lender. End of discussion, no need to look further. That's the end of the problem. And this was met with great resistance by a number of people, some attorneys general, some activists, some other people. And essentially what happened was that this rule issued by the OCC was repealed under the Congressional Review Act. And I promise this won't take too long, but under the Congressional Review Act, Congress can repeal a regulation issued by an agency if essentially three things happened. If the House passes a resolution of disapproval, if the Senate passes a resolution of disapproval, and if the president then signs it. And at different points in early 2021, in the change of the Biden administration, all of those things happened, and the OCC's true lender rule was revoked. And the OCC can no longer issue a rule that essentially, not the correct verbiage, but occupies the field.
Yeah.
So there is currently no federal regulation that defines who the true lender is. And therefore, that brings us all the way back to why we're talking about all these different things like DIDMCA, true lender, parity statutes, opt-out rules, because it really sort of breathed life into all of these different ways of talking about what the interest rate, what the on the loan really truly is.
Well, and Marty, if I could just jump in real quick there, I
Sure.
do think it's really important that, especially for everybody listening at home or in your office, all of these things there was an impetus behind why these things really began occurring. And the impetus really was a parade of terribles. Okay. Like, so Cash Call v. Morrissey, like parade of terribles, right? Like that people were being taken advantage of. Interest rates were, astronomical. Like these are reactions to really bad lending products that were available all over the country. I think it's important as we talk about, at least from the AFC's perspective, it's not that we're against regulation, and we're, we lend below the 36. It's the way that these types of, ideas of opting out or limiting the ability for good actors to participate when the bad actors are the ones that were really the reason that many of these rules and regulations and some of these challenges occurred in the first place. And it's not that we're not for that regulation, even for ourselves. And this even goes back to when Tom Curry the former OCC comptroller said, all right, well, let's do a fintech charter. And huge opposition to that. You know, the line of opposed people was from here to the moon wide on that, not long. Okay, well, we don't do that. How about a special purpose charter? Oh, no, not that either. Okay, well, what about an ILC? Oh, no, no. So it puts the good actors that are trying to comply with a myriad of state and federal, with our bank partners, with our responsible bank partners, where if you're trying to throw the baby out with the bathwater, then at the end of the day, the consumer that's most harmed by this is the consumer that needs access to credit responsibly. So I think it's important that we don't lose sight of the fact that all of these things that, you know, that basically put us here because there was a parade of terribles, but that's not everybody. And so there has to be, I think, a much more surgical and strategic way to look at this versus, oh, you know what, we're just going to get rid of the whole thing.
Thank
So,
you.
Rick,
I was going to actually jump to you, and I have a question for everyone. It sounds like there's a combination of the states being very active and trying to push back on any actions on the federal level that will basically take away their authority to set interest rate caps or regulate an institution that it wants to have its jurisdiction over. And that's what I think of when you said the pushback on the fintech charter, the national bank charter, the special purpose type of national bank charter. I don't see anything that will take power away from the state. So is it kind of like a state protectionism type thing in addition to consumer protection?
I would reframe it slightly differently. I would reframe it to say, to some degree, I would say that the AFC and the states are aiming at the same goal.
Mm-hmm.
And I think the goal is that to encourage responsible credit to be offered as widely and as availably as possible to citizens of their states. I think ultimately that's what we're all driving to. I think, unfortunately, there is no clear path. There's no clear way to distinguish what responsible credit looks like across all of the states. There are different avenues to approach that, and some choose to say, you know, I don't want to get involved in the discussion of whether responsible is set here or there or there. I just don't want to have anything to do with it. Some states are more, hey, I am able to. I do have a vision on what responsible credit looks like, and I want to set the bar here. There just is not a unified approach. There's no consensus on what that looks like. And so in some ways, we're aligned in what we want to do, and in some ways, we're at loggerheads in what we want to do, depending on.
And I think that's really well put, Marty. And I just want to point out that the stuff Marty explained about true lender and valid when made, it might sound to someone like, well, this sounds like financial engineering and banks trying to take advantage of approaches to maximize their profit. Just simply said, if a lender cannot share risk, and if a lender cannot sell a loan, if its liquidity needs require it to do so, loans across the board will be less available and or much more expensive, period. So consumers are served by these regimes, okay? And we can all identify a creep, right? That's a creep, and they're doing a creepy thing. We can all agree on that. But if the creep is doing that by exploiting a good rule, the solution ought not be kill the good rule. The solution should be, let's talk about how to go after the creep, but allow the good rule to stand. So the baby with the bathwater phrase that Rico used, that's really what AFC is in charge of doing. I found a bunch of babies. Can you please stop throwing them out with the bathwater? There's got to be a more rational way to achieve these ends. Consumers are served by valid when made and true lender and exportation and competition and fintechs. They are served by these things. And just because someone might, you use the cash call example, Rico, just because high cost lenders may build their creepy strategy on the rule, don't throw out the rule, because the rule does a lot of good. Look, securitization, right? We learned in 2008, 2009, and 2010, it can be done poorly. But we didn't ban securitization, because if you banned securitization, there would be no mortgage market. People couldn't buy homes. So it's about, it doesn't even have to be a rifle shot, right? It just has to have, it needs to be rational. Something that might appear to act against consumers upon further reflection, actually might, on measure, serve consumers' best interests 99 times out of 100. So how do we regulate responsibly to protect the innovation and the good guys? And Rico mentioned 36% as sort of emerged as a sort of a consensus, not really, but sort of a consensus or bright line. How do we allow them to innovate but not allow for 1,000% loans, right? Which no one on this call thinks 1,000% loans are a good idea. So that's really what it's all about. It's balance and understanding that not everything is so obvious as we wish it could be. It's complicated. So.
And competition too. Obviously, at the national level, national banks, are able to do their, products across the country at their, 35.99% rate. So by limiting that competition, you're limiting the choices consumers have in their home states, where not everybody might be able to get that, that credit card. That 640 and below FICO consumer might not be able to qualify for that, the national bank card. And so what's the alternative? Pawn shop, rent to own, check cashing, so.
Thanks for bringing up that point, Rico, and saying that national banks, there's not this similar opt-out provision in the National Bank Act. So even for states that are opting out with respect to their state charter banks, any national banks operating in their jurisdiction will continue to be able to effectively rely on the National Bank Act in terms of exporting interest rates from its home state. So I want to get into the Colorado. We've discussed it generally, but get a little deeper into what's the controversy there. We've seen a resurgence of states generally looking to enact opt-out laws for one reason or another. But there's challenges now with Colorado and with AFC. And so let's see, who would like to, speak on this first in terms of what's the issue in the Colorado case? Why is that one being challenged at this time?
Well,
not
I'll
it,
just
not it.
I'll just
I was gonna say
mention.
Chris or Tom,
Tom, go ahead.
give Marty a break.
So the Colorado litigation, which is, I sort of like to describe it as being in the first or second inning, right? So there's plenty to be learned as the case moves forward. From my view and the view of AFC, I think it's the early indications have gone well. I thought it was, I supported everyone's involvement in that litigation. Of course, if the case had started poorly, I would have denied that and said I warned everybody off. But it's going well so far. But there's plenty of ball game left here, right? So we need to keep paying attention, right? But basically, and it's not that everybody agrees, but this made in concept matters, right? We talk about loans made in the state, and if you have a bank in state 1 and a borrower who lives in state 2. I could see a lay person saying, well, the loan is made where the bank is. And I can see another reasonable person saying, no, it must be made where the person lives. And the truth is, that's not a new question. It's an old question. And it was pretty settled for a long time. A lot of people thought that, well, you have to actually dig a little deeper and you have to look at the facts. So things like, what does it mean to make a loan? Well, making a loan is really sort of two things. Decide whether or not you want to give somebody money or not. Right? So decisioning, underwriting, and then actually giving them the money, right? So if some bank based in Utah wanted to open up a loan production office or whatever the heck you call it in Denver, and they had an underwriter sitting in Denver, and people that lived in Denver walked into that office and they filled out a loan application there, and they were interviewed, and the loan officer in Denver said, well, let me do some math here. And they looked at you and they read your references and they checked your FICO score and they did all that. They said, great, congratulations. I gave you a loan. I'm going to give you a loan. And then they reached into the drawer and handed them cash. Well, that sort of feels like maybe that loan was made in Denver. It sort of feels that way. But that's not usually what happens. Really, the person might live in Denver, but the bank is in Salt Lake City or where Billings or wherever it is, right? And all that underwriting, all that thinking through, yes or no, do I want to make the loan? How much? At what price? All that underwriting might happen at that headquarters location, right? Or right? And then the decision to give them the proceeds of the loan, nobody gives anybody cash anymore. You send the money usually electronically, right? And where is that money sent from? It's sent from the bank. And where's the bank? It's in Salt Lake City, right? So you have to actually look at the facts of the circumstances, because you know what, a bank can make a loan in Colorado, but that doesn't mean that just because someone lives in Colorado that all loans to those people are made in Colorado. And that really matters for how we apply this DIDMCA rule and this exportation regime generally. And I think that some folks in Colorado took to the position that if the borrower resides in Colorado, it must be made there. And for most of my adult life, the FDIC disagreed with that. Somehow recently, they seem to have put in writing that they were okay with that view recently. That was, a lot of people fell out of their chairs or not when that happened. But that's really what I think the case is about. Like, there's a consensus that where the loan is made matters, and we got to figure that out. And I think the Colorado litigation will help us all figure out what that means. I thought it was already figured out, but the fact is some people that have important jobs disagree. So Colorado's about, can we please just understand what the rule is and move on? And if we lose, it'll be bad. I don't think that will happen, but you never say never. And if we win, at least there's some certainty out there. And later you'll, I'm sure, talk about what about the other states, right? But I think that, am I, Rico, Marty, you think I'm fairly characterizing sort of the heart of the Colorado litigation?
Yeah, I think a lot of it is driven by some of the things that Chris was talking about. Like you no longer walk down the street. And by the way, I think the person who walks down the street and enters into the bank is not making a loan. They are getting a loan or receiving a loan. But we can, for this purpose, we can leave that observation aside. But really what people are doing now is they're taking this thing, right? And they're doing it online. And for many of our members, almost all of our members, they're doing it online. And so what does that mean? They're no longer walking anywhere. Who knows what state they're in? They might be traveling. For some people, they might be overseas. It's very difficult to know where the customer actually is because they're really walking into their phone to do these things, or they're walking into their laptop to do these things. And so when you think about it that way, it's difficult, I would imagine, for a regulator to say, well, now I don't really know. Like I feel sort of like disoriented from a physical location. And if I want to choose a physical location, it seems much easier to me to choose the physical location of my resident. So from a regulatory point of view, I kind of see how they get there, right? But then it doesn't make sense when you think about it. The person isn't making the loan, going back to my earlier point. And also it turns out that humans move around. And so my favorite example on this is, imagine that you're in DC. Within the span of 10 minutes, you could be in Washington, DC. You could be in Maryland. You could be in Northern Virginia. If you have a particularly long application experience, you could find yourself in Delaware, New Jersey, Pennsylvania. All of this is in the same experience. And so where is the loan made if it's based on the location of the borrower? Is it wherever the borrower happens to be when they click accept on their phone? Is it wherever the borrower happens to be when the funds appear in their bank account? Like trying to tie it to where the borrower is located during the application process, during a particular phase of the loan, is simply an unworkable test. And from the maker's point of view, there's no way to know, did I comply with any particular state's interest rate? Because I don't really know where you are. So I think of all the tests, I think that is perhaps the least workable of the positions to take.
Yeah, that does seem quite confusing, especially when you put it in that context of the DMV area. So we've discussed how it's important to have some certainty with respect to the industry, banks, and from the regulator's perspective, want to focus more on fintech and partnership relationships, how unclear regulatory regimes impacts those relationships between fintechs and their bank partners. Throwing it out to the, all of the panelists.
Well, it's funny because for many years, Representative Garcia had been writing and introducing a 36% national rate cap. And, from the federal perspective, like obviously, that would solve a lot of, at least from our perspective, a lot of these problems, right? So if the national rate cap's 36, solves, all of our problems. But that's not going to happen. And so, now we're in this, 50 state regulatory regime, 50 state, different, as Marty had pointed out earlier, different ideas on where, where these rate caps need to be. And so from the question of the partnerships, many of us, many of our companies, are providing access to credit, especially to consumers that are in, 640 and below FICO tranches, where credit is hard to get. And traditional credit, so the example earlier of going down to the street and walking into your bank, well, that doesn't really exist anymore, right? So you've got everything's online. This is a whole new, brave new world of technology that allows for consumers to be able to access credit products, to be able to purchase the things that they need, or to be able to take out loans, or what have you. So the times have definitely changed. The future, it turns out, is here. And so being able to proportionally and correctly look at that and say, okay, if the interest is in the interest of ensuring that consumers have proper consumer protections, have disclosures, have the types of things that we all support, then let's move in that direction. If the idea is, oh, there are bad actors and therefore we need to get rid of everybody, well, then that really does hurt the responsible partnerships, because we partner with banks, we have our lending licenses in states, we have both the federal oversight through the bank partnerships, we have the state oversight through the licensing. To say that this is not regulated, or to say that this doesn't have some sort of oversight, it's just disingenuous. And when these bills or these laws are kind of given that broad brush of, oh, we're doing this because the bad actors, I can't tell you, I'll change the names, protect the innocent. We've had conversations with consumer advocates who are like, well, we're not worried about you, we're worried about the bad guys.
Mm-hmm.
But in worrying about the bad guys, you're getting rid of us too. And so you can't have it both ways. So anyways, I think that there are more elegant solutions than these very blunt tools.
So more surgical, you're saying, in terms of the approach. That's the theme I'm hearing, in terms of you're aligned, but just the way, the approach, how it's done.
Our bank partners are in the same position, right? They're FDIC supervised. Like, it's not like, we're not talking about folks that aren't supervised. We're not talking about folks that aren't, following the rules. We are.
Right.
And so I think that that's important, because, for all of us that have these partnerships, we're certainly, doing our part to ensure that from the responsible side of things, that these things are good. Not to say there haven't been issues, because there have, but there's, there've been issues with national banks. There've been issues with, it's not unique to fintech.
I just want to say, as a person who has worked for a fintech both before and after it partnered with a bank, I will tell you that, and again, I'll not use names either, Rico, but working with a bank is a real pain in the neck. It really is hard, but it makes you better, and it makes you better serve your customers, right? So imagine you have two fintechs. One says, I'll work under this patchwork quilt of 51 state regimes, where some states examine you within an inch of your life. Some states go 10 years between exams. Some states understand the truth in lending rules cold. Some states have no idea what they're talking. And again, forgive me, it's all over the place. And then you have another one that says, I want to run towards a regime where the FDIC is going to be all over you because you're in the bank sponsorship business. And the bank is going to pass along all of those compliance obligations and regulatory scrutiny and documentation and fair lending considerations and KYC rules, right? It is hard to work with a good bank. And a regulator should be saying, I wish everybody would work with a bank, because when you start working with a bank, you necessarily have to get better. Now, are there creeps out there who have used that approach to do lousy things? Yes. So go after them, right? If they're not making proper disclosure, sue them out of business, right? But working with a bank is a fintech opting into daily, constant, in some cases, overbearing scrutiny, and you just can't get away with anything. If you want to innovate, you have to go against really, really good lawyers and prove to them that this complies with whatever alphabet soup regulation applies to that regime. So look, I think regulators should say, please partner with banks because you're stepping into the daylight.
And you know, we work with a lot of responsible financial institutions, and they're not averse to regulation. They might not like a particular regulation, it might be onerous, but you know, at the end of the day, what the institutions we work with really crave is certainty, clarity. What are the rules? What do I need to do? What are my compliance obligations? And I'll do it. And what this 50-state approach does, and particularly when you have states trying to, okay, we're going to opt out, we think that means this. Oh no, it doesn't mean that, it means something else. That you can't get to that point. And you know, there have been efforts to try and address that, the FinTech charter, other ways to streamline. But you know, at the end of the day, these efforts complicate compliance and ultimately harm consumers in doing it, because it's not, you know, you guys want to comply. That's not, you know, that's never in question. It's just that when there's all of these moving parts and so much, you know, what does true lender mean in this state versus that state? It's unworkable. And you know, hopefully we'll get some certainty out of starting with Colorado in this case. But
thank you, Chris, Tom, Rico, Marty. So I don't see any questions from the chat. Please, we have a couple of minutes, so if you have a question, please add it now. But any last thoughts from the panelists?
You know, I keep going back to it. We get the, especially from our association standpoint, Marty being the chair of the board, like we get where, you know, a lot of these ideas came from, right? You know, we're supportive of things that eliminate bad actors, but we do think that we're also doing a tremendous amount of good work in our communities, tremendous amount of good work in providing access to credit to consumers that need it. You know, to consumers that have that, you know, thin file or low FICO file. The alternatives are very bad. And we're providing, at least we think, we're providing a responsible and transparent solution to consumers that that perhaps is getting lost in some of the desire to paint a broad brush on the industry. And unfortunately, you know, there is this thing called nuance. And in that nuance, consumers are getting responsible access to responsible credit. The $500 couch, when you purchase it on Affirm, is a $500 couch. It's not a $5,000 couch with compound interest and deferred interest and this, that, and the other. So, I mean, I do think that, you know, taking that hard look at what we're doing and how we're having these positive impacts in credit, in access, is important.
Yeah, I would pile on to that just a little bit. The goal of the organization is to enable responsible access to credit. And we do that through a variety of organizations, through a variety of institutions, a variety of arrangements, all of them with responsible access to credit as the core. It's our central value. And in doing so, we do welcome regulation. I want to be clear about that. We always have. We've written many comment letters. We have made suggestions. We meet with the regulators. We endeavor to have very positive relationship with state and federal regulators. That being said, sometimes we don't agree with a direction that perhaps a regulator or perhaps a state or perhaps a law or something along that comes along. We don't believe that those things are solving the interests of providing responsible access to credit. And though it is not our preferred course, if we feel that we need to do so to protect our entities that are meeting this very laudable goal, we will actually do what we need to do to preserve the organization's goals. So we are not always completely aligned with regulators, although we do believe that if they saw things our way, we certainly wouldn't be.
Thank you, Marty. And I think that's a great way to close it out. Thank you all for your time and serving as awesome panelists and giving some great insight and background information and history on DIDMCA, the True Lender Doctrine, the value when made, and then allowing us to dig a little deeper into the Colorado case. Thank you all for your time and have a great afternoon. And thank you all that attended and joined for this webinar.